Facing the loan process with bad credit can be challenging. Many Americans with fair or bad credit, generally a FICO score below approximately 670, know the struggle of getting approved for financing. Lenders view low credit scores as high risk, often resulting in higher interest rates and stricter terms for borrowers. In this guide, we'll acknowledge the challenges of bad credit borrowing and help you navigate them. We'll start by explaining what bad credit means and how it affects loan approval, then cover what to look for in a bad credit loan, like reasonable, APRs, and avoiding predatory traps. Next, we'll compare the top 5 personal loan lenders for bad credit in 2025, including their requirements, rates, and pros and cons. We'll also share tips on improving your loan offers, from boosting your credit score to adding a co-signer, and provide application advice and responsible borrowing tips. By the end, you'll have a clear picture of 2025's best personal loan options for bad credit and how to choose the one that fits your needs. Don't settle for high interest rates. Thousands are saving hundreds every month by finding smarter personal loan options online. It only takes 2 minutes to check your rate. No impact on your credit score. Click the link below to explore today's top personal loan offers and start saving before rates go up. What is considered bad credit? In FICO scoring, any score below 580 is generally deemed poor or bad credit. Scores from approximately 580 to 669 are fair, which still makes lenders cautious. Essentially, a FICO score under 580 falls into the bad credit range. For example, FICO ranges classify 300 to 579 as poor, 580 to 669 as fair, 670 to 739 as good, etc. If your score is in the poor/fair zone, many lenders label you as a subprime borrower, higher risk. This matters because the lower your credit score, the harder it can be to get loan approval. You may find fewer lenders willing to approve you, or you might only qualify for smaller loan amounts, shorter repayment terms, or higher interest rates. Credit score ranges and lender considerations. Lenders don't just see a number, they interpret your credit score as a risk signal. For instance, a score between 300 and 579 is poor, so lenders are more likely to see you as a risk. Many bad credit lenders will work with scores down to approximately 580 or even lower, but often scores closer to 600 give you more options and better terms. Aside from the score, lenders examine factors like your income, employment stability, and debt-to-income (DTI) ratio. In fact, your credit score isn't the only thing affecting your loan offer. Lenders also consider your income level, DTI, and even loan length when setting rates. For example, if you have a steady job and moderate debt, a lender might approve you despite a low score, whereas someone with the same score but no income or very high debts could be denied. Many online lenders today also use alternative data in underwriting, such as your employment history, education, or banking records, especially if they advertise being friendly to those with no credit or limited credit history. Why lenders charge higher APRs for bad credit? Simply put, it comes down to risk. Borrowers with poor credit have a higher statistical chance of missing payments or defaulting, so lenders offset that risk by charging more interest. Risk-based pricing means if your credit is bruised, you'll likely get an APR on the high end of the lender's range, often anywhere from about 20% up to 35.99%. Bad credit personal loans are usually unsecured, no collateral, which further increases the lender's risk. That's why interest rates for bad credit loans tend to be significantly higher than rates offered to prime borrowers. For example, a lender might offer 7% to someone with excellent credit, but quote 30+% APR to a subprime applicant. Lenders may also limit the amount you can borrow or offer shorter terms for bad credit loans. These measures help ensure they get repaid faster or don't lend more than they're comfortable risking. The bottom line, having bad credit makes borrowing more expensive. You'll face higher monthly payments and pay more in interest over time. This is all the more reason to shop carefully and try to improve your financial profile before taking on a loan. When seeking a personal loan with bad credit, it's critical to focus on key features and avoid predatory pitfalls. Here's what to consider. Reasonable APR and fees. Compare annual percentage rates, APR, among offers, since APR includes both the interest rate and any origination fees. Even with bad credit, some lenders keep APRs in a relatively moderate range, often capping at 35.99% APR, which is a common maximum for reputable personal loans. Be wary of loans with sky-high rates, anything well above 36% APR. For instance, payday loans can exceed 300% and are considered predatory. Also, check for origination fees, late fees, or prepayment penalties. Many good personal loan lenders charge an origination fee around 1 to 10%, deducted from your loan funds, but they shouldn't charge any upfront fee before approval. If a lender asks you to pay money before you get the loan, that's a huge red flag of a scam. Stick with lenders that are transparent about all fees and have no prepayment penalty, so you can pay off early if able. Repayment terms and flexibility. Look at the available loan terms, how long you have to repay. Standard personal loans offer terms from about 2 to 5 years for bad credit borrowers, though some lenders extend up to 7 years. A longer term means lower monthly payments but more interest paid overall, while a shorter term saves interest but has higher payments. Choose a term that gives you an affordable payment without stretching so long that interest costs skyrocket. Also, check if the lender offers any flexibility, e.g., the ability to change your payment date or hardship forbearance. For instance, a few lenders allow changing due dates or even offer skipped payment options once a year if needed. Such features can be helpful if your budget is tight, but always verify any conditions. They may require advance notice or come with fees. Pre-qualification with soft credit check. Ideally, find lenders that let you pre-qualify with a soft credit inquiry. Pre-qualifying means you can input your info and see estimated rates without affecting your credit score. This is crucial for bad credit borrowers because multiple hard credit pulls can ding your score further. Most top online lenders for bad credit do offer a soft check pre-qualify tool. Use it to compare personalized offers. Avoid any lender that guarantees approval without checking credit at all. Legitimate lenders will at least do a soft pull initially and a full credit check before finalizing the loan. Advertisements of no credit check, guaranteed approval are red flags of either extremely expensive loans or outright scams. Remember, if it sounds too good to be true, it probably is. Avoiding predatory lenders and scam red flags. Unfortunately, bad credit borrowers are sometimes targeted by predatory lenders or fraudsters. To protect yourself, know the warning signs. If a lender promises approval for everyone or doesn't review your credit income, be suspicious. Upfront fees are another major red flag. No real lender will ask you to pay an insurance fee or processing fee before you get the loan, aside from an origination fee deducted from the disbursed loan. Also, watch out for extremely short repayment periods, e.g., 2-week payday loans, or loan offers that pressure you to act immediately. Transparency is key. Predatory outfits often hide their true costs or won't clearly disclose APRs. Stick with lenders that clearly state their rate ranges, fees, and terms in writing. Additionally, verify any lender's credibility. Check online reviews, ensure the website is secure, and confirm they have a customer service line. Never share sensitive info, social security number, bank details, with an unvetted lender. By being vigilant and focusing on reputable companies, you can avoid scams and predatory loans that would only worsen your financial situation. In 2025, several lenders stand out for offering personal loans to people with bad or fair credit. We've compared 5 top options below. For each, We list the minimum credit score, typical APR range, available loan amounts and terms, plus key pros and cons. These lenders all consider applicants with imperfect credit, but each has its own strengths, so you can find the best fit for your situation. First, Upstart, best for non-traditional credit histories. Minjur credit score, none specified. Upstart accepts applicants across the credit spectrum and may approve those with no credit score or very low scores, approximately 300. APR range, approximately 6.7% to 35.99%. Rates vary by credit. Most bad credit borrowers will see higher end of range. Loan amounts, $1,000 to $50,000. Loan terms, 3 or 5 years, 36 or 60 months are standard. Upstart has limited term options with no extremely long terms. In some cases, it may offer a 7-year term. Overview. Upstart is an AI-driven online lender that pioneered using alternative data for loan approvals. Instead of relying solely on FICO scores, Upstart's model evaluates factors like your employment, income, and even education to gauge creditworthiness. This means if you have a thin credit file, or past credit issues but strong earnings, or a good education background, you might get approved when other lenders would have turned you down. Upstart is known for its fast funding. Many borrowers receive funds within 1 business day of approval. This lender does charge an origination fee, but it's transparent about it, typically 0% to 8% of the loan. Overall, Upstart is a top choice for those with limited or less than stellar credit history, especially if you have other positive qualifications that traditional scoring might overlook. Pros. Flexible credit criteria. Will consider applicants with no credit or very low scores, thanks to its AI underwriting. This opens the door for people who might be rejected elsewhere. Fast and easy process. Quick online application and funds often available in 24 hours after approval. Great for emergencies. Higher loan amounts available. Can borrow up to $50,000, which is on the higher end for bad credit loans. No prepayment penalty. You can pay off your Upstart loan early without any extra fees, saving on interest. Cons. High origination fees. Upstart may deduct a hefty origination fee, up to approximately 8%, from your loan, which effectively increases your cost. For example, on a $10,000 loan, you might receive only $9,200 if an 8% fee applies. APR can be steep for low scores. If your credit is poor, expect your rate to be toward the upper end, 30% plus APR. This is still an expensive loan if you barely qualify. Limited term options. Only 3 or 5-year terms, most loans, mean less flexibility in choosing your monthly payment. Some competitors offer a wider range of repayment lengths. No cosigner option. Upstart does not allow cosigners on personal loans. If you were hoping to add a co-borrower to boost approval odds, you'd have to choose a different lender. Second, Upgrade. Best for flexible terms and joint applications. Minjur credit score, 580. Upgrade is accessible to those with fair credit. APR range, approximately 7.99% to 35.99%, often starting around 8% for the most qualified. Loan amounts, $1,000 to $50,000. Loan terms, 2 to 7 years, 24 to 84 months. Very broad term options, so you can choose a shorter or longer payoff period. Overview. Upgrade is a fintech lender that caters to a wide range of credit profiles, including those in the fair/bad credit range. It's notable for offering great flexibility in repayment terms. Borrowers can select terms as short as 2 years or as long as 7 years, which is rare in this space. Upgrade also stands out by allowing joint applications. You can apply with a co-borrower, which can improve your chances if your co-applicant has stronger credit. The company even has a sister service called Universal Credit, also owned by Upgrade, specifically aimed at credit-building features. For instance, free credit score monitoring and budgeting tools, plus an auto-pay discount, come with universal credit loans. Universal credits loans are very similar to upgrades, so consider it part of the same family. Upgrades personal loans can be used for purposes like debt consolidation, home improvement, or emergencies. And if you choose debt consolidation, Upgrade can pay your creditors directly, simplifying the process. They do charge an origination fee, about 1.85% to 9.99% of the loan. Funding is quick, often the next business day after you accept an offer. All in all, Upgrade is an excellent option if you need a co-borrower feature or longer-term lengths to keep payments manageable. Pros: low credit friendly, accepts credit scores down to 580, so accessible to many bad credit borrowers. Joint loans available, allows co-borrowers, meaning you can apply with a partner or family member. A co-applicant with better credit could help you qualify or get a lower rate. Minus wide range of terms. Choose anywhere from 2 up to 7 years to repay. This flexibility lets you tailor your monthly payment. Shorter term equals higher payment but less interest. Longer term equals lower payment but more total interest. Fast funding and direct payoff. Approval and funding are quick, often one day, and Upgrade can send loan funds directly to your other creditors if it's a debt consolidation, potentially at a rate discount if you use it for that purpose. Credit building perks. Offers free credit monitoring, and setting up autopay yields a small rate reduction. These features can help you save money and improve your credit over time. Cons: origination fee deducted. Upgrade charges an origination fee of approximately 2% to 10% of the loan, which is taken out of your loan proceeds. This reduces the net amount you receive and increases your effective cost. No ultra-low APRs. Even with a co-borrower, interest rates bottom out around approximately 7 to 8% APR, so borrowers with better credit might find lower rates elsewhere. For bad credit applicants, expect rates closer to the max, high 20s or 30s plus percent. Average loan amounts. The max $50,000 loan is generous, but the minimum $1,000 loan is fairly standard. If you need a very small loan, under $1,000, or a very large one, over $50,000, Upgrade won't accommodate that. Fees for late or returned payments. Upgrade has a late fee, around $10, and a returned payment fee. These are common, but it means you should budget carefully to avoid any extra charges. Similar product to Universal Credit. This isn't a downside per se, but note that Upgrade and Universal Credit have similar offerings. You generally wouldn't apply to both, so no need to consider them separately, except that Universal might approve slightly lower scores with higher starting APR. Third, Avant, best for fast funding and user-friendly experience. Minirch credit score, 550. Avant targets fair to bad credit borrowers and is open to mid-500 FICO scores. APR range, 9.95% to 35.99%. Loan amounts, $2,000 to $35,000. Loan terms, 2 to 5 years, 24 to 60 months. Overview. Avant is an online lending platform well known for serving consumers with less than perfect credit. They offer unsecured personal loans that can be used for things like debt consolidation, emergencies, or major purchases. Avant's approval and funding process is quick. Many customers get a decision within minutes and receive funds as soon as the next business day. The company has a strong focus on customer experience. They provide a mobile app to manage your loan, and their customer support is available 7 days a week, which is a plus if you need help off hours. Avant loans have fixed rates, and they do charge an administration/origination fee up to 4.75%, though bank rate notes it can be as high as 9.99% in some cases. Avant is relatively lenient on credit. Many of its customers have credit scores in the 600s, but they reportedly accept scores down to the mid-500s. If you have extremely bad credit, You might still need a co-signer or to improve your score first, but for a lot of fair credit folks, 580 plus, Avant is often willing to lend when traditional banks won't. Overall, Avant is a solid pick for a quick personal loan with a simple, straightforward process, especially if you value good customer service and have at least a 550 plus credit score. Pros: low credit threshold. Accepts credit scores as low as approximately 550, which is lower than many competitors. This makes Avant a viable option if you're hovering in the mid-500s of FICO range. Minus speedy access to funds. Many borrowers get their money within 1 to 2 business days, faster if you complete all steps promptly. If you need cash for an urgent expense, Avant delivers quickly. User-friendly platform. Avant offers a mobile app and an easy online portal for managing payments, checking your balance, etc. They also accept multiple payment methods, credit/debit cards, checks, etc., which adds convenience. Customer support every day. 7-day-a-week customer service means you can reach Avant's support even on weekends. This can be reassuring if you have questions or issues outside normal weekday hours. No prepayment penalty. If you're able to pay off your loan early, Avant won't charge extra. This is standard for reputable personal loans, but still worth noting for responsible borrowers. Cons: higher starting. APR. Avant's rates start around approximately 9.95% for the most qualified borrowers, which is a bit higher floor than some peers. And if your credit is on the lower end, expect an APR in the high 20s or low 30s. It's not the cheapest loan option, but rather one of the more accessible. Origination fee. Avant may charge an administration/origination fee up to about 4.75%, sometimes cited up to 9.99% of the loan amount. While not unusual for this market, it does eat into the amount you receive. E.g., a $5,000 loan might have $200 plus deducted in fees. Lower max loan amount. The maximum loan is $35,000, which is lower than some competitors that go to $50,000 or higher. If you need a larger loan for, say, a major home renovation, Avant might not be sufficient. No cosigner allowed. Avant does not support cosigners or joint applications. Loans are only in one person's name. This means you can't bring in a creditworthy friend to help your approval odds. You must qualify on your own merits. Availability. Avant is not available in some states. For example, as of recently, they did not operate in Colorado, Hawaii, New York, West Virginia, and a few others. Always check if Avant is licensed in your state before applying. Fourth, OneMain Financial. Best for same-day funding and secured loans. Minier credit score. None specified. OneMain does not set a strict minimum. It will consider very low credit scores, focusing more on income and ability to repay. APR range: 18.00% to 35.99%. OneMain's rates start higher than others, reflecting its subprime focus. Loan amounts: $1,500 to $20,000. Ranges vary by state. OneMain has a relatively low maximum loan size. Loan terms: 2 to 5 years, 24 to 60 months. Overview. OneMain Financial is a long-standing personal loan lender that specializes in loans for people with bad credit. It operates a hybrid model. You can start the application online, but OneMain has 1,400 plus branches across 44 states for in-person service if needed. Unlike most online-only lenders, OneMain can offer secured loans. You have the option to pledge collateral, such as a car, to potentially qualify for a larger amount or lower rate. They also allow cosigners on loans, which can help if your own credit and income aren't enough. OneMain's biggest advantage is accessibility. They will work with people who have very poor credit or past credit issues, as long as you have some income and can demonstrate ability to repay. There is no minimum score requirement listed. They do, however, charge for that risk in the form of higher interest. The lowest APR is 18%, so these loans are relatively expensive. Origination fees apply too, varying by state. It could be a flat fee like $25 to $500 or 1 to 10% of the loan. If approved, OneMain is known for speed. You can often get the funds the same day, especially if you go to a branch and finalize everything, or even within an hour onto a debit card in some cases. Overall, OneMain is a top choice if your credit is really hard to work with, or if you need money immediately and want the option of face-to-face help. Just be aware of the cost. Pros: no minimum credit barrier. OneMain will entertain any credit score, even deep subprime. They focus on your income, debts, and whether you can pledge collateral rather than just the score. If you've been turned down elsewhere due to credit, OneMain might still approve you, albeit at a high rate. Fast, even same-day funding. OneMain can deliver funds quickly. If you complete the process early in the day, you might get your money the same day, sometimes within hours, via a prepaid debit card. This speed is excellent for urgent needs. Secured loan options. You can use collateral, like a car, truck, or other vehicle, to secure the loan. Secured loans may allow larger amounts or better rates if your collateral is valuable. E.g., you could borrow more by using your car title as security. Not many bad credit lenders offer this, so it's a unique perk. Cosigners allowed? OneMain permits cosigned loans, meaning a friend or family member can cosign if you both go to a branch to sign documents. A cosigner with good credit can improve your approval chances or help get a larger loan. In-person service. If you prefer to talk to someone, OneMain has physical branches where loan specialists can assist with your application and explain terms. The personal touch can be comforting if you're unfamiliar with loans. They also have a mobile app to manage the loan after funding. Cons: high interest rates. OneMain's lowest APR is 18%, which is much higher than some competitors' minimums. Many OneMain customers will pay near 30% APR. This is the trade-off for accepting very low credit. The loans are costly. Always calculate whether you can afford the payments at these rates. Origination and other fees. Depending on your state, you'll encounter origination fees, either a flat fee up to $500 or a percentage up to 10%. They also may charge late payment fees and non-sufficient fund fees. The fee load is heavier than some online lenders, so read your loan agreement carefully. Lower loan caps. With a typical maximum of $20,000, OneMain won't cover very large borrowing needs. Additionally, first-time borrowers or those with very low credit might be capped at even lower amounts until they establish a history with OneMain. Collateral might be required. For some applicants, especially for larger loans or borderline approvals, OneMain may require you to secure the loan with collateral, often a vehicle. Using collateral can be a pro, but it also means if you default, you could lose that asset. It adds risk for you as the borrower. Branch visit for closing. While you can pre-qualify online, many OneMain loans require a branch visit to finalize. Sign papers, perhaps show collateral. If you're not near a branch, this could be an inconvenience. However, they've been improving online processes, so it varies. 5. LendingPoint, best for fair credit and flexible approval criteria. Minimum credit score, approximately 580. LendingPoint's baseline is around 580 FICO, and they even consider slightly below in some cases with other strengths. APR range 7.99% to 35.99%. Offers can span from single-digit rates for better credit up to subprime rates. Loan amounts $2,000 to $36,500. Loan terms 2 to 5 years, 24 to 60 months. Overview. LendingPoint is a fintech lender focusing on consumers with fair to low credit scores who have solid income. They emphasize their use of technology and artificial intelligence in underwriting. looking at a variety of factors beyond just your credit score. For example, your location, job, and overall financial picture are considered to tailor an offer. LendingPoint's goal is to say yes when traditional lenders might say no. They're known for giving quick decisions and funding, often next day. If your credit score is under 600, LendingPoint may still approve you if other aspects check out. They've been noted to accept and fund people with scores in the high fives. The loan sizes go up to $36,500, which is a bit higher than some other subprime-focused lenders. LendingPoint does not allow cosigners, and their loans are unsecured. An origination fee up to 6% may apply, varies by state offer. One unique aspect: LendingPoint sometimes provides economic financial education tools and has been reported to offer rate reduction opportunities. For instance, they might reduce your APR if you make consecutive on-time payments, effectively rewarding good behavior. The best for rate reductions. Tag some, give them refers to these kinds of features. Additionally, they report to two of the three major credit bureaus, Experian and TransUnion, as of recent info, which can help you build credit, though missing Equifax is a slight drawback for credit building completeness. Overall, LendingPoint is a strong option if you're around the 600 credit score mark or rebuilding. They often give fair credit borrowers a shot with competitive, for subprime, rates, and a straightforward, fast process. Pros: fair credit friendly, willing to work with approximately 580-plus scores. If you're in the high 500s or low 600s, LendingPoint is squarely aimed at you, whereas many banks would decline. They also use alternative data to approve those with low or no credit history. Quick funding. LendingPoint can often fund loans by the next business day, so you're not left waiting long. The application is online and automated for speed. Competitive rates for the segment. Starting APRs around 7.99% mean that if your credit is at the upper end of bad, near fair, you might get a rate under 10%, which is relatively low for this category. Even their higher rates max out at 35.99%, keeping within a reasonable limit. No prepayment penalty and rate discounts. As with others, there's no penalty for early payoff. Plus, LendingPoint has been known to offer rate reductions over time. For example, possibly lowering your rate if you make on-time payments for a certain period. Not all lenders do this. This can reward you for good payment behavior. Flexible approval criteria. They're known for looking at high debt-to-income, DTI ratios, and still approving if you have enough cash flow. So if your income is solid but you have a lot of existing debt, LendingPoint might be more understanding than other lenders. They also consider side hustle income and other earnings, giving you credit for more of your financial picture. Cons. Doesn't report to all bureaus. Currently, LendingPoint reports loan payment history to only two of the three major credit bureaus, Experian and TransUnion. This means on-time payments might not help your Equifax credit report, and conversely, any issues won't be seen on Equifax. While not a deal breaker, full reporting would be better for rebuilding credit across the board. No cosigner or joint loans. You cannot add a cosigner to a LendingPoint loan. The application is solely based on your own profile. If your score or income isn't quite there yet, you can't boost it with someone else's credit. Moderate loan cap. The maximum loan amount, approximately $36,500, is lower than some competitors that go to $50,000 or beyond. If you need a very large personal loan, you might need to look elsewhere or consider a secured loan option. LendingPoint's loans are all unsecured. Origination fee. LendingPoint may charge an origination fee, often in the 0% to 6% range depending on your state, which will be deducted from the amount you receive. While this is common in bad credit loans, it's still a cost to account for, e.g. a 6% fee on a $10,000 loan means you pay $600 in fees. Availability. LendingPoint loans are not available in West Virginia or Nevada. And this can change, so check their latest state coverage. If you live in a state they don't serve, you'll need to choose another lender. If none of the above fits, other noteworthy lenders include Prosper, a peer-to-peer platform with co-borrower options, minimum score approximately 600, or Best Egg, which offers personal loans and even a secured loan option via asset collateral, min score approximately 600, with some of the lowest APRs if you qualify. Also consider local credit unions. Many have small loans or special programs for members with less than perfect credit, sometimes at better rates. Qualifying for a personal loan with bad credit is possible, as we've seen with the lenders above, but you'll get much better results and save money if you polish up your financial profile before applying. Here are some concrete steps to take before you submit that application to improve the loan offers you'll receive. 1. Check and improve your credit score. Start by pulling your credit reports and scores. You can get free reports weekly from annualcreditreport.com, and many sites offer free credit score monitoring. Scan for errors that could be dragging down your score, like incorrect accounts or wrong balances, and dispute any inaccuracies with the credit bureaus. Correcting an error could instantly boost your score. Next, focus on the two biggest factors in your score: payment history and credit utilization. If you have any late payments on current obligations, try to get current and stay current. Even a few months of on-time payments can start to help. Pay down credit card balances if possible to lower your utilization ratio, the percentage of credit limits you've used. For example, if you can pay off a chunk of high-interest credit card debt before applying for a loan, your score might rise and you're also freeing up room in your budget. Some quick wins. If you have a credit card, ask for a credit limit increase without a hard pull. A higher limit with the same balance instantly lowers utilization. Or consider becoming an authorized user on someone else's card with a good history. Their positive history could reflect on your report. While you might not have months to do a full credit rebuild, even a small increase in your score, say from 580 to 620, could qualify you for notably better loan terms. Lenders often have cutoff tiers, so bumping yourself up to the next tier can reduce your APR. Bottom line, clean up errors, pay down what you can, and demonstrate reliability before you apply. You'll appear less risky and get more favorable offers. 2. Reduce your debt-to-income ratio. Lenders look closely at your debt-to-income, DTI ratio, which is the percentage of your monthly gross income that goes toward debt payments. A lower DTI signals that you have more breathing room to take on new debt. To improve your DTI, you have two levers: decrease your debt or increase your income. On the debt side, as mentioned, paying off some existing debt, like credit cards, smaller loans, or any delinquent accounts if you can settle them, will both potentially boost your credit score and lower your DTI. On the income side, make sure to count all sources of income on your loan application, not just your main job. If you have a side gig, freelance work, alimony/child support income, or any other regular earnings, include them as allowed. You might also consider picking up extra hours or a part-time job temporarily. Even a couple $100 extra a month can improve your DTI a few percentage points. Many lenders prefer to see a DTI under 40% or so, but DTI under 36% is ideal. For example, if your income is $3,000 per month, keeping total debt payments under approximately $1,080, 36%, is a good target. If you currently exceed that, paying down debt or boosting income to hit that range will strengthen your application. Additionally, don't request an excessively large loan if you don't need it. The larger the loan, the higher the monthly payment, and the worse your DTI will look. Asking for just what you truly need can make approval easier and keep your DTI manageable. All these efforts show the lender that you're not overextended and can handle the new loan payments. 3. Consider a co-signer or co-borrower. If improving your own credit and DTI isn't enough or will take too long, one of the best ways to get a better loan offer with bad credit is to add a co-signer or co-borrower with good credit. A co-signer is someone, often a relative or close friend, who signs the loan with you and promises to take responsibility if you don't pay, effectively vouching for you. A co-borrower, joint applicant, is similar, except they are equally responsible and often share in the loan proceeds. Having a creditworthy co-applicant can significantly improve your chances of approval and get you a lower APR, because the lender will consider their credit profile in the decision. For instance, if you have a 580 score and your co-signer has a 720 score, you might qualify based on the higher score or at least get a rate closer to what a 720 would get. Not all lenders allow co-signers, as noted in our top 5 list. Upgrade and OneMain do, Avant and LendingPoint do not, etc. So you'll need to choose one that does. Also, make sure your co-signer understands the risks. They are on the hook to repay if you fail to, and any late payments will affect their credit as well. It should be someone who trusts you, and ideally, you trust yourself to not burden them with the debt. But if it's an option, a co-signer can be a game changer for loan terms. Even reducing your APR by a few percentage points thanks to a co-signer could save you hundreds or thousands in interest. As an alternative, if a co-signer isn't available, adding collateral, for lenders that offer secured loans, could similarly improve your chances. Offering to secure the loan with a car or savings might persuade a lender to approve you or cut the rate a bit since their risk is lower. Whether via a reliable co-signer or valuable collateral, strengthening the application with additional backing can lead to a much better loan offer. By checking these boxes before applying, cleaning up your credit, shoring up your finances, and leveraging a co-signer or collateral, you'll present a much stronger application. This means more approvals and lower rates in many cases. Even a few weeks of improvements can make a difference. So if you have the luxury of time, use it to put your best foot forward. Once you've chosen a lender and feel ready to apply, it's important to go through the application process, prepared, and to have a plan for responsible repayment. Here are some tips for the application itself and for managing your loan wisely. Documents you'll need. Getting your paperwork in order ahead of time will make the application smoother and faster. Typically, personal loan applications, especially for bad credit loans, will require the following documents or information. Proof of identity. A government-issued ID like a driver's license, state ID, or passport. Lenders need to verify you are who you say you are. Have at least one current valid photo ID ready. Proof of income. This can be recent pay stubs, W-2 forms, or tax returns if self-employed. Some lenders accept direct deposit statements or bank statements that show regular income. The goal is to show your steady income source to repay the loan. If you have multiple jobs or income streams, gather documentation for each, e.g. freelance invoices or benefit award letters. Employment details. You might be asked to provide your employer's name, your position, and how long you've worked there, possibly with a contact number for verification. Occasionally, lenders may call your employer to verify employment. They typically won't disclose it's a loan, just verification. Bank account information. Since personal loans disperse funds electronically, you'll need an active checking account. Be ready with your bank account and routing numbers for the account where you want the loan deposited. Also, many lenders automatically set up payments from that account, so ensure it's one you use regularly. Contact information, your address, phone number, email, and sometimes references. Ensure your contact info is up to date and consistent across your application and your credit report. Other financial obligations. Some applications ask for details on your monthly rent mortgage payment, and possibly copies of utility bills or a lease to confirm address. They may also ask about your existing debts, though they'll see most on your credit report. Social Security number. For the credit check, you will need to provide your SSN or ITIN. This is standard but just be sure you're inputting it on a secure, legitimate application site. Having digital copies, PDFs, or clear scans of documents like pay stubs, ID, etc., can speed up the process. You can upload them quickly if requested. Some lenders, especially bad credit lenders, might use automated income verification, like linking to your bank to see deposits, which can skip some paperwork. But it's wise to have the documentation on hand regardless. Use the loan wisely. Once approved, be strategic about how you deploy the funds. Personal loans for bad credit often come with higher interest, so every dollar borrowed is a dollar that accrues interest until you pay it back. Borrow only what you truly need, not the maximum you qualify for. It can be tempting to take a bit extra just in case, but remember, you'll pay interest on it. If your goal is debt consolidation, make sure to actually use the loan to pay off those high-interest debts immediately. It's a common mistake to get a consolidation loan, then not pay off the credit cards in full, which leaves you with both the loan and still credit card balances. To avoid this, you can choose lenders like Upgrade, Lending Club, etc., that offer to pay creditors directly as part of the loan disbursement. That ensures the old debts are cleared. If the loan is for an emergency or necessary purchase, car repair, medical bill, use it for that purpose and try not to divert it to something else. Keep the funds in a separate account if needed to avoid temptation. Also, create a budget that incorporates your new loan payment. Add the monthly payment into your expense list and possibly cut some optional spending to accommodate it. The idea is to treat the loan payment like a must-pay bill, just like rent or utilities. Planning ahead will help you avoid missed payments. You might find it helpful to use a budgeting app or even a simple spreadsheet to track this. Setting up repayments. It's strongly recommended to set up automatic payments, autopay, from your bank account. Almost all lenders allow this, and many even give a small APR discount, around 0.25%, for using autopay. This ensures you never forget a payment. Missing a payment on a personal loan can severely hurt your credit and often incurs a late fee. Time your autopay date to something that works for you, ideally right after you get your paycheck or a date where you know your account will have funds. If the default due date is awkward, e.g., right before your payday, ask the lender if you can change the due date. Many will allow you to adjust it to better align with your cash flow. Communication and support. If you ever anticipate trouble making a payment, life happens, job loss, unexpected bills, etc., contact your lender immediately. Many lenders, including those for bad credit, have hardship programs or can offer a one-time deferment or reduced payment for a month. It's far better to arrange something in advance than to just miss a payment. OneMain, for example, might work with you if you call, and others like Avant or LendingPoint may have options as well. Staying in touch shows you're responsible and willing to find a solution. Avoiding new debt pitfalls. After you take the loan, try to avoid running up new balances elsewhere. The goal is to improve your financial health. If you consolidated credit cards, resist the urge to use those cards heavily again. This is key, so you don't end up with double the debt. Perhaps keep one card for small purchases to keep it active, and pay it off each month. But put the others aside until your loan is comfortably paid down. Finally, remember that a personal loan is also an opportunity to rebuild your credit. By making all your payments on time, you'll add positive history to your credit report each month. Over the course of the loan, you should see your credit score rise if you're managing everything well. This can set you up for even better financial options in the future, maybe a lower interest loan or credit card, etc. So treat this loan responsibly as a stepping stone. In summary, be organized in applying, with documents and info ready, be disciplined in using the loan funds for their intended purpose, and be proactive in repaying. Budget wisely and automate what you can. That way, your personal loan will serve its purpose, whether it's relieving financial stress or consolidating debt, and you'll come out of it in a stronger position. Taking out a personal loan when you have bad credit can feel daunting, But the landscape in 2025 offers several solid options for borrowers in this situation. We've discussed 5 top lenders: Upstart, Upgrade, and its universal credit platform, Avant, OneMain Financial, and LendingPoint, each with their own perks like alternative credit evaluation, cosigner support, fast funding, or flexible terms. To recap, if you have a thin credit file, Upstart's AI-driven model might give you a chance. If you need a longer term or want to apply jointly, Upgrade could be ideal. For quick cash and a straightforward experience, Avant is a great pick for mid-fives and up. If your credit is very low, or you want in-person help or a secured loan, OneMain Financial stands out. Just budget for the higher cost. And for those around the fair credit range seeking a fast online process, LendingPoint offers flexibility and decent rates for the category. Before you jump into an application, remember to shop around and compare rates. Many of these lenders allow a soft credit pre-qualification. Take advantage of that to see estimated offers side by side. Even a few percentage points difference in APR can save you a lot of money. We encourage you to use the links in the description, if you're watching this as a video, to check your personalized rates with these lenders. It's free to compare, and it won't hurt your credit score to pre-qualify. By doing so, you might find that one lender offers a significantly better deal for your specific situation than the others. Also, consider looking into credit union loans or payday alternative loans, PALs, from credit unions, which often have capped interest rates. If you qualify for those, they can be a cheaper lifeline for small loan amounts. But for larger personal loans, the lenders we covered are among the best bets for bad credit. Most importantly, borrow responsibly. Only take a loan if you truly need it and have a plan to repay it. Use the strategies we discussed, like boosting your credit, reducing debt, or adding a cosigner, to set yourself up for success. Once you have the loan, make your payments on time and in full. Not only will this prevent any extra fees or credit damage, but it will also help improve your credit score over time, opening up better financial opportunities down the road. We hope this guide has given you clarity and confidence in finding the best personal loan for bad credit in 2025. Even with past credit challenges, you have options and the ability to move forward financially. Take your time to compare, read the fine print, and choose the lender that best meets your needs in terms of rates, terms, and service. Good luck with your loan search. If you found this information helpful, please check out the description for more resources and the latest rate offers from these lenders. And don't forget to subscribe to our channel for more financial tips and guides on rebuilding credit, saving money, and making smart money moves. With the right knowledge and tools, you can turn your financial situation around one step at a time. Thank you for watching, and here's to your financial success in 2025 and beyond.